US national debt is now at its highest levels in history. And as you can see, this staggering level of debt is constantly expanding, every hour, every minute, every second, right in front of your very eyes. In fact, since the start of the COVID pandemic in early 2020, the debt has exploded by 45%, reaching its current eye-watering level of $34 trillion. And with debt levels skyrocketing to unprecedented heights, Jim Rickards argues that the US is hurtling towards a fiscal precipice. The best-selling author and investment banker believes that excessive debt not only stifles economic growth, but also undermines the long-term stability of financial systems. Rickards contends that the current trajectory of borrowing and spending in the US is completely unsustainable, posing a grave threat to the nation's economic well-being. With a track record of accurate predictions, including Brexit and the Trump presidency, Rickards' insights are not to be ignored. And his predictions suggest we should soon expect a seismic shift in the US economy, with significant implications for investors. In this video, we'll cover the reasons why Rickards is so concerned about the US economy, and why he believes such dire consequences are imminent. Make sure you watch the full video, as at the end, we'll be showing you what you can do to protect yourself against the impending economic disaster. So, let's get started. At the heart of Rickards' concerns lies the record-setting levels of its national debt. But how did we get to this point? Well, the government has expenses it needs to cover each year for things such as schools, roads, social security, military equipment, and social services like Medicare and Medicaid. By themselves, these expenses already cost the government a significant amount of money, with its annual budget for these expenses currently at $6.5 trillion. The government earns income to pay for these expenses in the form of federal income tax, but when it's spending more than it earns, a budget deficit results. And the US is currently running a budget deficit of $1 trillion each year. To pay for this deficit, the government borrows money by selling treasuries, notes, and bonds. All of these securities pay interest to its investors, which the government must pay. The national debt is the accumulation of this borrowing along with associated interest owed to the investors who purchased these securities. As the federal government experiences recurring deficits through spending more than it earns, the national debt grows. It is not uncommon for governments to borrow money to finance their expenditure, and in normal circumstances, a reasonable level of debt should be sustainable. However, there have been a number of events in the last 20 years which means that US debt has spiraled out of control. First, there were the wars in Afghanistan and Iraq in the early 2000s, which greatly increased spending on the military. Then there was the financial crisis in 2008. Markets crashed, people lost jobs, and the US government had to spend big to bail out banks and the economy. Then came the pandemic in 2020, through which Congress spent $3 trillion of emergency aid on things such as payroll protection plan loans and extended unemployment benefits. This extra spending was critical to keep the economy from completely collapsing, but it has compounded the debt problem the US currently finds itself in. As you can see from this chart, the US national debt has grown significantly over the last 40 years or so, from $4.2 trillion in 1983 to $34 trillion at the end of 2023. That's an almost 700% increase in only 40 years. This means that the current level of government debt is over 5 times the size of its annual $6.5 trillion budget. If you want to stay updated on the latest global financial news and money topics that can help you build your wealthy life, please don't forget to subscribe to the channel. Okay, moving on. There are many economists and politicians that believe that this level of debt doesn't matter. In their view, increased public spending stimulates private sector activity. For example, an increase in government spending leads to higher incomes for workers and businesses involved in the government projects. These individuals and firms then spend a portion of their increased income on goods and services, further boosting aggregate demand. This additional spending generates additional income for other individuals and firms, leading to further rounds of spending and income generation. And when the government borrows money to spend money, they believe that there is a multiplier effect, as the increased spending will ultimately lead to the private sector, spending more, increasing economic activity, and creating more economic output, or GDP, than the money borrowed. In other words, they believe that for every $1 borrowed by the government, it can create, for example, $1.50 of additional output for the economy. However, this is not a perspective shared by Jim Rickards. Rickards argues that this relationship between debt and GDP requires a specific set of circumstances to hold true. In his view, the economy either needs to be in a recession or just coming out of recession. It needs excess industrial capacity and labour capacity, and, perhaps most significantly, it needs to have low levels of debt. Rickards argues that piling up debt beyond a certain threshold poses significant risks to economic stability and growth. This echoes the sentiments of economists Carmen Reinhardt and Kenneth Rogoff, whose groundbreaking research highlighted the detrimental effects of high public debt on long-term growth prospects. Their theory, known as the Reinhardt-Rogoff theory, suggests that when a country's debt-to-GDP ratio surpasses a critical level, typically around 90%, it begins to impede economic expansion. In other words, at 90% debt to GDP, you go through the looking glass and every dollar borrowed gives you less than $1 in GDP. According to the Reinhardt-Rogoff theory, growth rates tend to decline as debt levels rise beyond this threshold. They suggested that high debt levels lead to lower investment, reduced productivity, and ultimately slower economic growth. One of the main reasons for this is through the crowding out effect. When a government needs to finance its spending, it issues bonds. These bonds represent loans that the government must repay with interest over time. However, when the government borrows extensively, it competes with other borrowers, such as businesses and individuals, for available funds. Due to the increased competition for funds, lenders and investors in the financial markets respond by raising interest rates. As a result, the government must offer higher interest rates on its bonds to attract investors. This rise in interest rates means the government must pay more in interest payments on its outstanding debt. This can strain the government's budget and lead to higher debt servicing costs over time. And in the Reinhardt-Rogoff theory, when GDP to debt exceeds 90%, every dollar that the government borrows and spends on the economy leads to less than $1 of economic output. This concept is also known as diminishing marginal returns and can be explained using the example of Tim. A year ago, Tim took a $20,000 loan from his local bank to open a coffee shop in his local town. Since then, business has gone well, and Tim's coffee shop attracts a steady stream of customers eager for his delicious coffee and pastries, and Tim experiences significant growth in sales and profits. The shop quickly captures a large share of the local market, and Tim establishes a loyal customer base. At the end of the year, Tim's coffee shop makes an overall profit of $40,000. Encouraged by his initial success, Tim decides to open a second branch on the other side of town. To do so, he takes out a second $20,000 loan to fund the fit-out costs and to get the shop up and running. Initially, the second branch also enjoys strong demand as customers are excited to have another location nearby. However, Tim soon realizes that the growth in sales at the second branch is not as impressive as it was for the first branch. Some customers seem to prefer the original location, and there is more competition in this second location. The second branch still contributes to Tim's overall profits, making $20,000, but the incremental increase in sales is smaller compared to the first branch, and Tim's profit on the second shop is equal to the size of his bank loan. Tim soon expands further and opens a third branch, taking on an additional loan of $20,000. However, the third branch attracts even fewer new customers than the second branch did. Tim notices that the overall increase in sales from the third branch is modest, and the costs associated with operating multiple locations, such as rent, utilities, staffing, and the additional interest on the loans he needed to fund his expansion, begin to eat into his profits more significantly. After considering all these additional costs, the third branch makes a profit of just $10,000, less than either of the first two branches and less than the loan Tim took out to fund its expansion. The concept of diminishing marginal returns suggests that as Tim continues to expand his coffee shop chain, each additional branch contributes less to his overall profitability than the previous one. This is because resources, such as prime locations, loyal customers, and skilled staff, become increasingly scarce and spread thin across multiple locations. Eventually, there comes a point where the costs of expansion outweigh the benefits, leading to a plateau or decline in Tim's overall profits. And the Reinhardt-Rogoff theory on debt is no different. It states that when GDP to debt exceeds 90%, every $1 that the government borrows and spends on the economy leads to a diminishing level of economic output. To review how sustainable a country's level of debt is, economists compare a government's level of debt to that country's GDP. In 1980, US debt to GDP stood at 35%. In 2010, it had grown to 90%. But in the last few years, it has shot up to record highs, reaching 123% by the end of 2023. In other words, the US government now owes way more money than its economy produces. Applying the Reinhardt-Rogoff theory, the US economy hit an inflection point in 2010 when its debt to GDP ratio was 90%. Since then, every $1 of debt that the government has taken on is leading to less than $1 in additional output in the economy. Over this time, GDP, the denominator, has shrunk while the national debt, the numerator, has accelerated. The result is the rapidly expanding debt to GDP ratio that we see today, and at its current levels, every dollar borrowed by the government is having a much reduced impact on GDP. As Rickards puts it, high levels of debt are acting as a serious headwind to growth. Lenders, including other countries, investors and financial institutions, use the debt to GDP ratio as an indicator of a country's creditworthiness. A lower ratio typically suggests a stronger ability to repay debts and may result in lower borrowing costs for the government. Conversely, a higher ratio, like the US currently has, can make lenders nervous. When the government borrows more, it must issue more bonds. But if investors fear the government can't keep up with payments, they will view it as a less trustworthy lender. They will then demand higher interest rates, or yields, on those bonds to compensate them for the higher perceived risk of default. Higher bond yields increase the government's costs of borrowing. And currently, the government is incurring $810 billion of interest on its debt, which amounts to 12% of its yearly budget, just on servicing its debts. That's $810 billion that could have otherwise been spent on education or social security. And that interest is increasing minute by minute, meaning the US government must continue to allocate more funds to pay the interest, diverting resources from other essential areas. High levels of debt and higher costs of borrowing relative to GDP can constrain a government's ability to respond to economic downturns or emergencies through stimulus spending or tax cuts. As to do this, they would need to borrow even more at increasingly high interest rates. This can hinder long-term economic growth by crowding out private investment, reducing productivity, and increasing the likelihood of financial crises. And this is why Jim Rickards is so worried about the US economy. In his words, "Our debt to GDP ratio is out of control. That debt overhang is the biggest single problem in the financial landscape." Rickards believes that the debt burden will worsen current economic challenges and hinder recovery efforts in 2024, leading to an economic crisis. If you want to know how to protect your money during these scary economic times, click on this next video to get started. Thanks for watching, and until next time, keep building your wealthy life.